Thank you everyone for joining the APREA Preqin joint webinar on the post-COVID-19 future. We're just about to begin, but I did send out a poll for everyone asking where you're joining us from. Feel free to answer that before we get started. All right, it's 10:30, so I'm going to kick us off. Hello everyone, this is Kai from Preqin. Thank you all again for joining our post-COVID-19 future APAC real estate in the next decade webinar, which has been jointly produced by APREA and Preqin. I'm going to look for our results on our poll. Well, it looks like, well, most of us are joining from our homes. I think it's a place we've maybe gotten a little too familiar with over the last couple of months. I know I can't wait for lockdowns to end, and probably most of you can't as well. Now, before we start, just some housekeeping notes. You're on mute, but please feel free to use the Q&A box anytime to send through questions, which we will address at the end of the webinar. We will also have a very short survey at the end of today's session, where 5 lucky respondents will win a complimentary copy of our 2020 Global Real Estate Report. So make sure you stick around for that. Now, without any further delay, let's get started. Preqin and APREA have joined forces to develop the APREA Preqin Quarterly Monitor, which uses interactive infographics to showcase the performance of closed-end private real estate funds focused on the Asia Pacific. If you haven't seen the monitor yet, my colleagues will be sharing a link in the chat box on the right side of your screen so you can take a look. So today's webinar, we will be sharing some of the latest findings of the APREA Preqin Quarterly Monitor, as well as discussing the long-term outlook and trends post the COVID-19 pandemic. To give us the opening address, I'd like to welcome our esteemed partner, Sigrid Zielsita, the Chief Executive Officer of the Asia Pacific Real Estate Association. She is responsible for overseeing the strategic direction, initiatives, and operations of the association across the region. Sigrid, thank you for joining us. Please get us started.
All right, thank you, Kai. A good day to everyone. I'm Sigrid Zielsita, CEO of APREA. Very delighted to welcome all of you to our inaugural webinar with Preqin. And our discussion today will be focusing on private real estate in the region. As Kai has mentioned, Preqin has been our partner since June of last year in tracking performance of closed-end private real estate funds focused on Asia Pacific. So I hope that you've had the chance to look at this tool. It's quite an essential one if you're benchmarking your funds. As you already know, the pandemic has already derailed the near-term prospects for all countries around the world. Fortunately, in Asia Pacific, we are seeing Greater China improve. We've also heard in India that site visits are slowly taking place in some of their markets. And while nothing is assured without any vaccine, the green shoots that we are seeing, we're hearing on the ground are pretty significant. Specifically, they're happening at a time when many of us in the region are gearing up for reopening in the next few weeks. So given this, our series of webinars have been focusing on collectively charting a path to growth in the respective markets, making sure that the markets are able to restart responsibly and judiciously, and of course, leveraging on opportunities. From our end, we in APREA will continue to work with all of you to make sure that we have the channels such as this for us to have an intelligent discourse, and at the same time to be able to work with our policymakers to ensure that the needs of our stakeholders in this industry are being addressed, especially during these challenging times. Now, as many of you know, the slowdown in investment activity has been quite pervasive. But this is not really a surprise. While it has been a departure from what we've seen in the past several years, what we're seeing, and I've mentioned a while ago and hearing, is that people are still sorting through the new norms. So our discussion today will be shedding light on what's happening in the private real estate across Asia Pacific. So for those of you who are looking for similar updates in other parts of Asia, we encourage you to look at some of the webinars that we have over the next few weeks We have planned in Hong Kong, Australia, and in China. So please do check the APREA website for more details. So thank you once again for joining us today. And I'd like to turn this back over to Kai. Please enjoy the webinar.
Thank you, Sigrid, for kicking us off. Next, I'm going to introduce EFI, who will present the latest findings from the APREA Preqin Quarterly Monitor. EFI leads Preqin's research strategy and operations in the Asia Pacific, coordinating our multilingual research teams in the region, as well as building key industry relationships from our Singapore office. Thanks, EFI, for dialing in. Now over to you.
Thanks a lot, Kai, and thank you very much, Sigrid, for the welcome address. Good morning, good afternoon, everyone. Once again, we'd like to welcome you to our webinar. As we're dealing with the pandemic, there will be a lot of questions about the short-term impact as well as the long-term ones. So we're using this webinar in the next 15-20 minutes or so. I'll be touching on some of the points on how the pandemic has affected fundraising and deals so far. If we can go on to the next slide, and then also have a look at the important work that APREA and us have done to bring more transparency to the industry through the quarterly monitor that we have that Sigrid mentioned. And as a part of this, an index of APAC real estate funds, which has seen consecutive quarters of growth. So, and finally, I will round up by an understanding of the near and the long-term impact of COVID-19 on real estate here. Before we start, I'd like to show you a map of the locations where Preqin has operations in. Just 5 years ago, there wouldn't have been so many points on this map, but we have expanded really aggressively since, especially in Asia. And that really just highlights our investment in this region. And it's very apt that we're talking about the next decade of APAC now. We are very positive about the prospects of APAC as a whole. It is the fastest growing region in the Preqin business. And as a response to that, late last year, we opened a Tokyo office, and earlier this year, we started a team in Sydney. And all this is with the objective of bringing better, more comprehensive, and more timely data to our clients, as well as better service overall. Before we dive into the data bit, here is another poll to get everybody warmed up. So with regards to the general state of the real estate industry, how do you feel now in May compared to April? And this is with respect to any work that you're doing. You may be a law firm doing deal advisory or fund formation activities. You may be an investor deploying capital in the space, or you may be a fund manager looking to do deals or to do exits. So really, it's just each of us in our own areas of the industry. How do you feel right now about the state of real estate? I'll give us a little more time, maybe 10 more seconds for your response. So I can see on my screen, the bars are moving. I can see it's pretty balanced across all three now. And I'm just going to allow 5 more seconds for more responses. All right, excellent. So let's have a look at the results. So about half of us are saying that, you're quite neutral. So things haven't changed too much from last month, and kind of like an even split between those who are saying it's more positive and more negative. And I guess, that is really a reflection of where we are globally as well as in APAC with respect to the pandemic, because it's advancing in different stages in each country. So diving straight into the data now, the coronavirus has had a deeper impact on Asia than anywhere else because it started circulating here much earlier before spreading west. And I'm sure that everyone will agree that fundraising conditions were tough in the first quarter. So this chart shows just how tough it was. You can see that it's the lowest quarter of the 5 years we have on this chart. If we extended this chart to 2014 and earlier, we'll see that in Q1 this year, where 7 funds raised $1.5 billion, is actually the slowest Q1 in 10 years. And not only that, the number of funds to have closed have also dropped. In an average year, what we can expect this number per quarter to be is in the mid to high teens. But that has dropped to single digits this year. Although Q1 was poor, if we combined Q1 and Q2 and look at it as a first half, it is actually comparable to the first half of 2015 and 2016. And if we looked at even earlier years, it is definitely better results. So even though 2020 may look bad so far, we are actually miles ahead of just a few years ago. So the opportunistic and value-added strategies have made up the bulk of fundraising over the years, and we expect that this to be continued in the longer term. And that's because as Asia economies continue to expand, new buildings will be needed to meet the commercial, residential, and logistics needs of a growing population. And in terms of finding success, between 20-30% of the total capital each year is raised by US headquartered managers. And these are typically bulge bracket firms that target large pensions in their home country. And of the remainder, Hong Kong, Singapore, and Australian managers make up the majority. And Hong Kong GPs are arguably one of the most successful in the region, for they have raised more billion-dollar funds than others here. Time in market, and that is the time taken for a fund from launch to final close, averages 15 to 18 months. And it usually takes a shorter time for lower risk strategies like core plus funds, while value-added and opportunistic funds takes a little bit longer. So that's on the fundraising side of things. On deals, we saw a drop in activity beginning in 2018, and that followed the start of US-China trade tensions. There was a healthy recovery last year, which made it the second highest year on record. Same as with fundraising, 2020 started slow, and Q2 seems even slower, although we have not wrapped up Q2 yet. And that's because lockdowns across APAC is starting to bite. We surveyed about 300 investors and fund managers in April globally, just to get a better understanding on how this pandemic was affecting the alternatives industry. And the results were put together into a Preqin house view, which provides a useful roadmap of the way forward. I think my colleagues will be sharing the link to that house view under the chat function. So these conversations produced two main reasons why deal making slowed. Number one, there were travel restrictions and a lack of in-person meetings. That meant due diligence could not be completed. And secondly, the original valuations no longer made sense. As the world settled into working from home, commercial assets like offices started to lose their luster, and there are now even talks of companies moving permanently into hot desking and home working after this crisis is over. And retail malls, which have long suffered from the rise of e-commerce, have faced even more questions over their existence. So I would caution, though, that there are exceptions. One example is here in Singapore for suburban malls. They remain resilient as they continue to be the focal points for the community to hang out in their free time and to do grocery shopping on weekends. So one interesting point on Asia, which may not be apparent on this chart, is land deals. And That's represented by the light gray bars. The 3 largest deals completed in Asia last year were raw land assets in mainland China and Hong Kong. In fact, the 15 largest land deals across all of APAC in recent memory were in the same locations, with the majority in this area that's now known as the Greater Bay Area. And this region is forming the tip of the spear for China's development in the coming decades. So it is an area worth watching for all of us in the space. The interest in APAC real estate has been backed by good fund performance. It has also prompted APREA and us to join forces in producing an index for the industry to benchmark performance. This is the industry's most comprehensive and accurate resource. We cover over 230 constituent funds, 10 key markets, 7 strategies, and $147 billion in market cap. It is available on the link here, which my colleagues have just shared, where you also find an interactive calculator that lets you see where your fund or your desired returns sit on a customizable benchmark. Here on this chart, we can see that index returns has been rebased to 100 as of December 08, and following the GFC, returns, of course, inevitably dropped, but the industry has made a strong recovery since 10 years after the GFC. NAV plus quarterly distributions, net of call capital, has risen 45%. And even more encouraging is the consecutive quarters of growth in 2019. What we should expect, though, is a reduction in capital calls and distributions in the near term. And before we talk about the why, let's pause here for another poll. So the question now is, how soon do you think the global economy will be back on its feet? Option 1, is it going to be in Q3? Option 2, Q4 of this year, or option 3, 2021. So if we could launch the poll, I would love to hear from you, what you think, when you think the global economy will be back on its feet. And as the responses roll in, I found this on Reddit, on the internet. It says here it's an old photo of people eating in restaurants, but this was really just taken last year, right? So I'm sure that's one of the activities that we have dearly missed, as all of us or most of the world have been kept behind doors in their own homes. As you listen to me drone on and on, don't forget, if you have any questions for me or for the panel later, do feel free to use the Q&A function to submit your questions. I know that Kai will be collating these responses, and if we have time, we'll put them through to the panel nearer to the after my session. So I'm just going to keep the poll open for the next 5 seconds. If you haven't responded, please do take the time to let us know your comments. There are no right or wrong answers. We really just want to know your honest and unvarnished anonymous view. Cool. Okay, so let's close the poll now and have everybody look at the results. So the vast majority says that it's going to be in 2021, not this year. So nobody thinks that it's going to be in Q3. No surprises there, because most of global economies are still either just starting to ease some lockdowns, or they are still in the midst of very strong movement control measures. So this question is important for us to understand, and that's because having a view on when the global economy will be back on its feet, will really allow us to plan the way our business operates, as well as to do some modeling, which is, what I wanted to show you guys in the next slide. So this is a forecasting model of how capital calls and distributions will change based on a brief but sharp contraction in the global economy. So we map this out a pandemic scenario where an economic rebound begins in the second half of this year. So it's the minority view, right? It's a very optimistic case that we've just built out. And the model allows us to map it any number of scenarios and tweak it according to how bullish and dovish we are. So although this is a model for private cap in general, there are useful takeaways for us on real estate. So this analysis focuses on 2017 to 2019 vintages, and that's because these funds hold most of the dry powder. So assuming the global economy undergoes that significant but brief recession and then recovers, our model suggests that GPs will respond in two stages. Stage one, sharp reduction in cap calls and distributions. These are represented by the blue and the yellow bars in the first half of this year, and then generating a net positive cash flow in the second half. Accelerating capital calls and distributions through the later half of 2021, and that's the second point, because asset prices and deal volumes are going to rebound. As a result of this pandemic, for the 12 months ending June 2021, we can anticipate that funds of these vintages will reduce cap calls by 38% and reduce their distributions by 19%. And that's because we expect deal activity to be muted and distributions delayed as GPs look for valuations to settle into a pattern before they look at buying or selling. And they also wait for greater economic certainty. At the same time, GPs that would otherwise be looking for an exit will hold on to their assets to avoid selling in such a downturn. So in our survey last month, of the LPs that we spoke to here in APAC, 50%, so that's half of them, said the number and size of planned commitments to alternative funds this year will decrease. Not because they've got liquidity concerns, but mostly due to the denominator effect. So the value of their public equities portfolio has dropped, and that's caused the value of their illiquid portfolio to have risen in comparison. And the number and the size of their planned commitments will also decrease this year because of an uncertainty over the outlook of some sectors. But for the vast majority of investors, the long term, and this is the next 10, 15, 20 years, the long-term strategy for alternatives has either not changed or has actually been strengthened by the pandemic. So knowing that investors are here to stay, how should we as an industry work to future-proof their portfolios? So first of all, I think we need to be aware of key sector risks. Until a cure for the pandemic is found, as long as the world still needs to live under some sort of lockdown conditions, rental income from retail, office, and the RESI sectors will continue to see an impact. In addition, there is a real drop-off in the valuation of RESI assets brought on by the contraction of the economy. And you can see this in this chart here. And just last month, we asked investors which are the sectors they'll be looking to avoid, and residential, came up as one of the top ones. In the longer term, as more and more consumers buy online, brick and mortar retail will continue to be under pressure. Logistics and data centers have held up well in this pandemic so far, and a law firm told us that advisory work continues to flow for these two areas. In fact, logistics and data centers have also held up during the volatility brought on by the trade war last year. So the traction of these assets is intrinsically linked, right, to the rise of technology. The world is only going to move further and further into the adoption of tech. So investors incorporating sectors which move in concert with tech will serve to future-proof their portfolios. And that brings me to prop tech. It is a burgeoning space. We have seen how real estate has adopted technology such as smart buildings. These are buildings which log and send data on energy usage, footfall, faulty equipment, the whole gamut of big data that we can collect, so that these things can be managed in an automated and smarter way. And we have also heard someone is trialing out the use of drone footages of building exteriors, as well as 360-degree views of the interiors of buildings and assets as a way to overcome the inability to conduct physical inspections. The conversation around the ESG has matured a lot, especially on the governance component. And I would say that this pandemic has driven home the importance of governance. Is there creative accounting here? How do I know that this asset really exists? How do I know it is in a good condition without going through a physical in-person inspection? Is this particular manager overly reliant on one rainmaker? What if he or she were to be out of action because of the pandemic? So we understand that ESG data is patchy, so we have sought to centralize it by bringing all of this data under the home of alternatives. So I'm pleased to let you know that we track which investor and fund manager has an ESG and impact policy, and whether they are signatory to related organizations such as the UNPRI. And in the months ahead, we will be looking to do some really cool tech stuff with this data. So more to come on this front. And with that, that really rounds up what I wanted to share with us today. This is our 2 cents worth on how the industry is doing, as well as some of our thoughts on how we can future-proof our portfolio. If you have any questions, please do feel free to submit through the Q&A function. And thank you very much for your time. I'll now hand over the time to Kai.
Great, thank you, Ifai. You shared some encouraging points for the industry, which shows stakeholders are adapting and evolving, and that there might be some bright spots to the crisis. And maybe more importantly, that despite COVID-19, investment in the asset class is likely here to stay. This actually sets the scene quite nicely for our panel discussion. COVID-19 has presented a very unique set of challenges for the Asia-Pacific real estate market, some of which Ifai did mention in his presentation. And a lot of questions are emerging from GPs and LPs at the moment. To help shed light on some of these uncertainties, we will now hear from some industry experts on what lasting effects and opportunities are emerging as a result of the pandemic. The panel discussion will be led by our moderator, Shirin Tang. Shirin is the Singapore managing partner of global law firm Morrison Foerster. She is a corporate lawyer who has practiced in both New York and Singapore. One of her specializations is the structuring of complex transactions for real estate asset managers and investors. In the course of her 20-year legal career, Shirin has led a number of large, innovative, and award-winning corporate real estate transactions in the United States, Southeast Asia, India, Brazil, Japan, and China. So we are very happy to have her here with us today. Thank you, Shirin, for your time. Please take us away.
Thank you, Kai. Thank you, Preqin and APREA for this opportunity. And as Sigrid said, it's been challenging, right? This pandemic for all of humanity, and Preqin's useful APAC update has really shown the disruption to our industry in Asia as well. But today's panel is really about charting a path forward and exploring some of the opportunities in the different markets and how investment strategies may be evolving to pick up on some of these opportunities. And so we're very fortunate to have as panelists today, David Kim from ARA and Terence Tang from Colliers International. And let me briefly introduce them. So David is the CEO of ARA Private Funds, APAC Real Estate, where he oversees the private real estate funds division that invests across the Asia Pacific. David also sits on the group's business development committee, which drives all new business initiatives. And he has over 20 years of real estate industry experience. Before ARA, he was managing director and chief operating officer of Blackstone Group Asia, based in Hong Kong. And prior to that, he held these very same leadership roles in the Real Estate Principal Investments Group at Bank of America Merrill Lynch. So welcome, David. And Terrence, with the nice painting behind him, he's Managing Director of Asia Capital Markets at Colliers International, where he directs a team of more than 130 senior executives across Asia. And Terrence specializes in advisory services and principal real estate investment management. And he has a track record of over 30 years of successful transactions all across Asia. Prior to joining Colliers, Terrence held senior directorship roles at GIC, the Government of Singapore Investment Corporation, at Investco Real Estate, at AIG, and at JLL. So with that, David and Terrence, welcome. It's great to have you both on the panel because you each bring such different perspectives. David, from the helm of ARA Private Funds, which is invested across such a broad range of asset classes and strategies, and Terrence, from the perspective of a trusted advisor with insights into what the marquee names in our industry are doing and thinking. So with that, let me start with a broad question, right? So what are your thoughts? We've heard the data from Q1 and the very comprehensive summary that Preqin has put together. What are your thoughts on private real estate in Asia as we climb out of COVID-19 in varying degrees across markets? And how are strategies evolving? And so maybe let me pose the first question to David. And are you able to share what are some of ARA's strategies in Asia and more broadly to capture the opportunities?
Sure, thanks. You know, fundraising has been impacted, there's no doubt. LPs across the board, and we've conducted one-on-ones, group sessions, etc., have remarked that they've put investment committee decisions on hold, and rightfully so, as people wait to see what the permanent or long-term impact is. However, when you look at across the board and where yields have gone, as well as where central bank interest rates have gone, which have decreased anywhere from 30 bips to over 100 bips, you'll see that people are craving safer, more yielding assets. And we do believe that alternative assets such as real estate will still remain an attractive decision, albeit I think there will be impact in terms of investor preference. As everyone knows, hospitality and retail assets have been severely hit. We'll have to wait to see what that impact is. So investors will gravitate towards certain sectors versus disliking some of the others. As for ARA's position, again, our bread and butter is really in some of the main real estate sectors that we've operated in for the past 17 years. Office, retail, and now with our Logos joint venture in the industrial and logistics space. Logistics space, Terrence can opine on, has been one of the hotter sectors in recent times, given the e-commerce as well as the increasing popularity due to their stable yielding nature. But that's something that we will continue to focus on. In terms of geographic locations, I think what we're looking at is really to harvest and continue to operate in the countries that we do versus looking to expand in more countries that we haven't done so in the past. Whereas last year, we've seen a number of new opportunities come across our desk in some of the countries that we haven't operated in before. But that's something that we will look to develop in a more strategic focus.
Got it. Thank you, David. And Terrence, from your perspective of advising clients, are you able to talk about some of the strategies that you're seeing your clients thinking about across the different markets?
Sure. Definitely. Maybe what I would do is to start off with a bit of a recap of what Preqin as well as David has mentioned. So for the first quarter of this year, we saw investment activities have, like what Preqin said earlier, has been held back, deals withdrawn, and so the volume actually dropped as much as 50% across Asia Pacific on average. The only markets that has sort of spare is actually Korea, India, and Taiwan. It's very interesting. They see an uptick of 10% on activities in Q1. In terms of sectors, it also supplement what was said earlier. The industrial sector is the only sector across Asia Pacific that contracted only 10%. The rest have contracted between 30 to 60% in terms of activities quarter on quarter last year. But industrial sector, we saw only a 10% contraction, which is very good in this market. And with that, investors, I mean, one of the reasons why that happens because investors are actually, like what you heard earlier, is unsure. They are not sure what is the new valuation of risk premiums to be accorded to the different asset classes. In fact, what we saw in the US over the last few months is that because the banks, the financial institutions in the US have problem to sort of value the risk premium, they decided not to lend any more to real estate in the short term. So it's almost impossible to get that from US banks. And that affects some of our Asia Pacific deals. Some of our deals, one of the deals that we're working in Japan, a couple of US banks were actually lining up, sign an MOU, but they decided to pull off when COVID hit US in a big way in March. And then we ended up work with a Japanese domestic bank who finally funded that opportunity. So with that scenario, investors today, if you ask them to commit on any deals, it has to have very big motivation. There are probably two. One is substantially discounted value, right? So the question is, how much is that substantially discounted? So is it going to be distressed? What we are seeing in Hong Kong is that some of the deals that we were working on, particularly hotels deals, they dropped the asking price by 30%, but the bid prices coming at 50%, and there's still a gap. Who is going to move first? We are actually not sure. But Hong Kong is definitely a market that we are seeing recovery of activities. We're seeing transactions. Strata title offices are transacting at 25% of previous valuation. China is probably the next we are seeing recovery of activities. Asking prices is only dropped by about 10%. The other motivation that investors will look at is some security over income. So besides looking at distressed deal, investors will also want to make sure that any investment properties that they go into, they need security of income. So they're asking for like a sales and leaseback guarantee, income guarantee, NOI guarantee to ensure that they can tide over the next couple of years. So these are some of the tactics the investors will want to go for. In terms of preferred asset class, I very much in agreement with what David and Preqin said earlier. It is the logistics, the industrial sectors, as we heard earlier, that is still attracting interest in the space. In fact, in China right now, there's a huge surge in demand for data center. Like the Chinese government is relaxing regulations to accommodate the development in this sector. So case in point in this industrial sector is that we saw APG, CPIB, JV with ESR. It invested $1 billion in South Korea logistics. And for data center, we saw GIC, joint venture with Equinix, investing $1 billion in Japan. And of course, these are the deals that they may have entered into earlier this year, but they went ahead to close the deals. These are my take on what investors are doing today.
Thanks very much, Terence. That was very enlightening, I think. You said a couple of things that it'd be interesting to dive in on a little bit, but I just wanted to say, so from our perspective, I guess, as a legal service provider, I spend about 70 to 80% of my time working on logistics deals at the moment, logistics and data center deals. So it all ties in. I think we're all sort of seeing the same thing. But Terence, you mentioned a couple of things. So sale and leasebacks, you mentioned, I think you said sale and leaseback guarantees, and you were seeing that, from investors. I guess it's a question for both of you. Are you seeing sort of more opportunities in sale and leaseback transactions. I think it's been reported that regionally there's been an uptick because of liquidity needs, that people are starting to sort of re-optimize their portfolios that way.
David, you want to go ahead first?
Go ahead, Terence.
Okay. Now, I've been working on sales and leaseback deals for many years. Most of the time, sales and leaseback involve a couple of situations. First is where multinational corporations, decide to monetize the assets to go asset light. So that goes with the corporate strategies. Which is very much ongoing. We see a trend, in the early days started with the US companies and then with the European companies. Only recently we saw some of the Asian multi-corporations doing that. We help LG, Korean company, recently to divest an asset. So we are seeing all this on and off. But of course, this current situation may speed up some of these strategies that the multinationals have in mind. Cash flow may be an issue, so the corporates may have to start to looking at whatever they have and monetize the asset. But of course, it may not be the best of time to monetize, but they have priorities in what they do, what is their core business. So since their core business is not in real estate, they may need the funding almost immediately. I will not say that there are a lot of them coming out, but I'm sure that some of the corporates are really looking at their portfolio and see what they can do, with their portfolio. And I see more of the Asian and the European. The Americans, years ago, they already started. They have been asset light for a long time. But the Europeans and Asians, a number of the corporates are still quite asset heavy. Yeah. So the other aspect, the other situation when we see sales and leaseback is when the vendor trying to make the deal more attractive to the investor. So that happen all the time as well. When he's trying to achieve a certain valuation, which in order to enhance the valuation, he will provide some form of guarantee on the income. But there is sometimes cause conflicts and issues in terms of structuring the deal. Because providing the guarantee doesn't mean that the vendor will continue to manage it. Does it have master lease? How do the new owner going to value add on the assets? So there are many other issues on sales and leaseback. Yeah, that's my take on the question.
Great, thanks. David, anything? If not, then did you want to say something about that, or I had another question?
Sure. Go
okay.
ahead.
So the other thing that was interesting that Terence mentioned was seeing more distressed deals. And I guess maybe that's a good segue into a question about fund strategy, and maybe I'll address this to David. But, are we seeing a change in fund strategies? Is there maybe more of a demand for, distressed funds? I think one of the only large closes at the end of Q1 was a fund, an Asia fund that included distressed debt in its remit. So, are we seeing sort of a more interest in that, and then more generally in terms of fund strategy, are you seeing any, is there a demand for more diversified funds? Is there, a willingness to give the manager more discretion to adapt investment strategies as things change? Or is it the opposite where, the managers have less discretion because the likes of, I guess, the pension plans and, they are going to want to have more control over those decisions given the uncertainty?
Sure. I think what we've seen, at least in Asia, is really an inbound queries more on the credit side versus distress. I would say credit being really, again, an alternative form of borrowing for banks who have pulled back in certain jurisdictions. So credit inbound queries have increased significantly versus, I would say, distress not so much, just because the bid-ask spread between buyers and sellers is still quite wide. And I think this will be a slower burn as you see cash flows and NOIs being impacted, probably 6 to 12 months down the road. And when you look at valuations, again, people have a more of a wait and see attitude, where first quarter valuations across the region generally haven't dipped a whole lot. Hopefully, as Q2 and Q3 emerge, people will realize some of the severe impact that the cash flows have had. But to your second point, I think one of the benefits that people have realized to be diversified across the pan region is really beneficial. And if you happen to have invested in a country specific or sector specific fund in a country that's been severely impacted more so than others, I think that's really where people have realized the benefit of diversifying across retail, office, multi-asset classes and multi-regions, especially during these times.
Right. I guess maybe one of the exceptions to the diversify across asset classes is really logistics, right? We're actually still seeing, a lot of interest in logistics specific funds. But so I guess picking up again on something that Terence said, I think you were starting to talk, Terence, about how you're seeing recovery in Hong Kong. But that's an interesting, I guess one of the questions is, how much of an impact is the government response in each of these countries having? And, is there sort of things like economic stimulus packages, relief for tenants? Do you see sort of a long-term impact of the government response on the performance of your portfolios or your clients' portfolios, Terence, or is it more of a a short-term sort of reactionary thing? And it's a question for both of you. So.
Okay, maybe I just start off with some very simple observation that I think at this point in time, all the governments have reacted. Of course, everyone has come up with different packages and managing the crisis very differently. But what I see in terms of a trend is that most of these packages are about preserving jobs, saving jobs, and helping the SMEs. In fact, in some countries like Japan and Korea, the packages are strictly helping local SMEs. So even the foreign companies like us, we are not going to get anything. But in certain countries like Singapore, Hong Kong, it's all across the board. So different government has managed it very differently. But what we probably need to see is stimulus packages that are a lot more longer term, which is actually more for priming the economies, more for longer term growth. We have not really seen that actually at this point in time because all the government are busy preserving jobs, saving jobs. So I guess the next stage, probably hopefully it will come in the next couple of months or so, after some of this government has managed the crisis, sort of stabilize it. Once this situation is stabilized, the government will probably embark into the next stage of introducing stimulus that inject growth to the economy. So we hope to see more like infrastructure investment in terms of incentives to real estate developers, to consumers, and of course lifting of cooling measures in most part of Asia, because over the last few years many Asian countries have cooling measures being introduced to stabilize the real estate market. So that is probably I hope we'll be able to see in the next few months. Yeah.
Terence, did you have anything on this topic, or?
Sorry, that's all from me. Thank you.
Okay. And David, did you have anything to add? Or?
No, not much to add. I think what we've done in the first couple of months of the COVID situation is to pass on some of the savings from the government relief programs to our tenants where possible. We have tried to work with the tenants, but as Terence said, really the temporary measures can only go so far. Ultimately, the consumers need to start spending again, and that's where really the stimulus and the resulting vibrancy and footfall, etc., will have to come from. And how do governments do that is really the question. Interestingly enough, when we look at China and the footfall data that we've seen across malls, initially footfall fell 90% in the first 2 months. It's crept back up to about, I would say about 75–80% of pre-COVID numbers, but sales are still lagging, and that's where really we're still monitoring occupancy costs for our tenants, where, you know, at a certain point, they're not going to be able to maintain a viable break-even profit margin should sales still lag, and that's a real concern for us. So we're really hoping the government stimulus can help to provide that spark needed to get consumers to spend again.
I guess another aspect of that, David, so we talked about retail and, you know, the consumer spending. Another aspect of that, I guess, is office space. And this is one that is I think close to anyone, is close to the heart of anyone that manages an office, like me, trying to figure out what we're going to do in terms of our physical office going forward. But one other aspect, I guess, is, you know, and it's tied also to the government response in terms of work from home measures and how they're going to open up the economy and allow people to go back to work. But let's talk for a second about the new normal, right, and the future of work and how that might affect the use of space and office space. I mean, so work from home, you know, has really become recognized now as actually viable. And, you know, if it's more widely adopted post-COVID, as, you know, was said in the keynote speech, how does that, I mean, what are your views on how this might affect things, right? And I guess it's not homogenous across all the markets, because it really depends on that particular city, right? Whether it's viable to work from home, you know, how do people live in Asian cities? People live in smaller residences with multiple generations. It might not be so easy to work from home. And in a place like Singapore, where you have good public transportation and you don't actually have to travel hours and hours to get to work, maybe it's you know, easier to be at work. But it'd be interesting to hear your views on that, both of you, and maybe we start with Terence again on that.
Sure. Now, interestingly, for Colliers in Asia-Pac, we are seeing very different reaction, and we are seeing different measures in place. Some offices are half open, some are closed, some are still, you know, you're able to go back to office, some is total shutdown, you know. Some offices have a lot of our business come from facilities management. Like in India, we have a few thousand people, and 1/3 of the people are actually managing facilities. So I think the key question is this: with this new normal, what would the occupiers' new behavior will be? You know, how we can imagine how it will be. I think it has to do with, like what you rightly say, it will definitely be different from markets to markets, and culture will have a play in this. But I think let's talk about in developed markets like Hong Kong and Singapore, which will probably be setting a sort of the standard for the new normal. So we will definitely see smaller group meetings. We will definitely be seeing occupiers doing more telecommuting, less travels. You know, airline fares may shoot through the roof when they open up. So people will travel less because it's too expensive to travel. So and then the other thing is occupiers will be definitely across the group will be very concerned with hygiene, health, and safety. And some of this may be addressed by government regulations. So all this will affect configuration and building specification. So as any real estate owner or managers, you know, we need to understand how this behavior will affect the new configuration that required and the new specification required. So in terms of configuration, I think column-free office will definitely be here to stay, but more flexibility will be introduced into the usage of the office. So we may see movable partitions. We may also see mobile offices, meaning mobile rooms. Rooms in the office can be moved around, you know, because they are mobile partitions. We should see more cubicle offices. You know, the open plan office will change. to a certain extent. I think we'll go back to where we were before, where we see more cubicle offices, but probably more mobile than before. Control access. So we're seeing a few access points into one office currently. We may see less of that. Maybe we only have one entry and one exit point, unless for emergency use. And more tenants' information will be shared, less privacy. These are the things that we will notice in terms of when you configure the office, and tenants' improvement in the office space will be minimalized. So there will, you don't spend too much on tenants' improvement anymore, because you need to have a more mobile office and a flexible office. Of course, there's this core and flex thing that I'm going to talk about later on. But then the next thing beside configuration is the building specification. So the workplace, the government will require higher standard of safety and health equipment, air conditioning. This sick building syndrome has to be addressed. Making sure that all this is of higher quality. Security step up, CCTV, face recognition system, entry controls, and enhanced process in terms of cleaning and maintenance. Instead of cleaning twice a day, you have to clean 4 times a day. These are the things that's going to happen. And what it means, actually, it means a higher maintenance cost. It means some of these higher services charge, maintenance costs may have to pass to the tenants. I think we heard from Singapore minister recently saying that all these measures that requiring in the construction sites, we're going to increase construction costs. So it's the same logic as for building. So all this will happen. And as I say, let's come back to the core and flex arrangement. So the tenant will focus on the core arrangement, but likes to have some flat space. The landlords may have to provide that flat space. But in order to provide that flat space, the landlord may require something back. So they will ask for a higher deposit, and they need to structure very creative rental structure with the tenants to accommodate this flex space that the tenants will require. So I think there will be a lot of evolving parts in terms of configuration, in terms of building spec, and in terms of the leases. But what will be the end product? Actually, time will tell. But I think that this is still very much evolving. Thank you.
Yeah, just to add to that, I mean, I think you hit it on the head, where certain countries where you have multi-generations or small square footage, in those countries, people are going to be severely impacted, and working from home is not as comfortable. Landlords have, again, expanded their co-working, leasable areas, either to third parties, or some have tried to go on their own. And I think that's going to be quite critical as occupiers really rethink how much of their businesses really can be moved online versus offline, and thus the need for that creative, flexible working space solution.
So in terms of co-working, I know the audience is quite interested. I saw a few questions on co-working as well. So you mentioned co-working, David. Are you so do you foresee that the boom in co-working, right before this happened, is that likely to continue as perhaps as part of, the core and flex strategy that Terence mentioned?
Even before the COVID-19 situation, we were seeing demand from our tenants with regards to that. And I think what has cemented really during the COVID-19 is the idea that people can work from home. Of course, there is a need for human and physical interaction, but that co-working need is even more evident now. And I think landlords would be prescient to really try to provide that space, whether through their own or through third-party capital, co-working operators.
Right.
And, you don't go overboard and try to lease up a third of your building to co-working, and that's really concentration risk. But having anywhere from, call it 10 to 15% of your typical building space would, be advisable and, really practical from occupiers who have come to us to look for that space. And even, non-traditional office settings whether you have a retail podium or even our convention center in Singapore, for example, are offering those temporary flexible working space situations.
Thank you, David. So I think that probably addresses one of the Q&A questions. I've sort of preempted it. The other, we have a couple of minutes, but the other aspect, I guess, of the new normal and working from home is technology. And, you know, as Ifai mentioned in the keynote, and maybe I'll address this to David first as a sort of last question, but do you foresee that we're going to see an increased deployment in technology across the various, you know, asset classes to optimize utilization, you know, occupancy, efficiency across the supply chain? I guess, you know, so we have clients in the logistics space, and you know, they've already for many years been using technology in that way to gather data for occupancy, to measure, you know, optimum utility, to allow them to have differentiated pricing. But do you think, I guess, as a landlord across asset classes, do you think that this is going to be more widespread across different sorts of real estate assets?
Yes. You know, across the board, people are trying to think of new ways. And I think, you know, I mentioned ESG as an important source. Investors have always focused on ESG, but I think what's brought to attention during this situation is really a renewed focus on how landlords can make their buildings much more efficient, and whether that's putting in energy efficient solar panels, ways to save air conditioning costs, especially as Terrence mentioned, we have seen an uptick in your maintenance costs across the board. Again, these things may be small, but when you add them up at multiple entry points, you know, double the cleaning, etc., they do add up. And when you're looking for core investments where percentages of basis points matter, those can really impact your returns. And so, you know, to mitigate that is really how do you become more energy efficient, you know, your governance issues, etc. And that's really a focus that we can try to squeeze on the other end in order to mitigate that higher operating costs.
Right. I see that we're just about out of time. So maybe Terrence, if you wanted to say something on this, or we can take Q&A.
I think just on your last question is that this COVID is sort of like speed up, fast forward the adaptation of technology in all real estate in a very significant way. And I think a year ago, I was in Japan, and we saw a hotel that is totally not serviced by any human being. You know, it's totally robotics, AI, everything is self-serve. And this will definitely be leapfrog, you know, in the industry, you know, with all this facial recognition. Some office landlords are still reluctant to introduce that. I know ARA has introduced it. So more landlords will be forced probably to step up in some of this. So I think robotics, AI, data analytics, this will come a big way with real estate going forward.
Thank you, Terrence. I'm going to turn it back over to Kai, who's managing the Q&A.
Thank you, Sharon, for leading our panel. And of course, thank you, Terrence and David, for sharing your expertise with us. Sharon, would you mind joining the panelists now for the Q&A session?
Sure.
I'm going to start asking some. Let's see. Let's start with, do you think the demand for commercial assets such as office and retail malls will decline in the longer term? Or do you think will?
Well, okay, maybe I just start off with similar. No, the demand will still be there. And in any real estate asset classes, asset sectors, there will always be demand because people want to use it. I mean, real estate has value because of the economic activities within the real estate. So it could be office, it could be retail, it could be hospitality, it could be logistics, anything. So as long as someone uses that space, the value is determined then by demand and supply. So the value of office or retail will very much depend on how the thing will evolve. But with all this happening, the format will change, the usage efficiency will change, but there will still be value in this asset.
Terrence. David, did you want to add to that a little bit?
No, I echo that sentiment. I think, you know, demand, again, human beings are resilient. Everyone's lived through the GFC and SARS, and, you know, we feel quite impacted now, but hopefully when the vaccine is, you know, created, etc., people will tend to have shorter memories. And so
yes,
I think
yes,
you will hopefully see a normal creeping back up.
I guess just quickly as a related point on that, I mean, it's been interesting seeing the evolution of retail in this whole crisis, right? I mean, you know, there's a lot of discussion about whether e-commerce is going to just overtake the demand for retail malls, but it's been interesting to see how even the high-end retailers have adjusted. And so I agree with all that, where people are going to want to see the goods, they're social, they want to actually go and look at the shops. That's why, you know, David's saying they've seen footfall go up in China. But it's been interesting to see how the traditional brick and mortar retailers are now also doing e-commerce. The high-end luxury handbag brands, for example, the personal example, but you know, that you could never once buy online. And now I think they're going to really deploy a combined strategy where they will continue to have the, you know, the prestige, the trophy locations in person so that people can go and see the product. But now they have the added sort of full e-commerce platform behind them as well.
Awesome, thank you. A few actually participants asked about specific markets, so I'm going to pivot a little bit. Which markets in Asia do you think will be the first to recover? Which countries do you think will expect the most foreign investment flows?
Sure, maybe I'll take that on and start, and Terrence and others can chime in. But, you know, the quickest recovery, at least from our perspective, if you could call it a recovery, is Korea and China. Again, when you look at investor demand and liquidity in Korea, it's as if COVID never happened. There is excess, not only foreign liquidity seeking assets, but also domestic liquidity. And that wall of capital looking for yield, which Korea tended to be higher in the first place compared to the rest of the Asian countries, has really picked up. And China, to a certain extent, has come back where, again, the social measures that have been placed have really spurred investment sentiment. Now, whether or not there's an ease of capital inflow transactions, et cetera, remains to be seen. But, you know, those are probably the two countries where we have seen significant recovery, if you will.
I very much agree with David, actually, because in Korea, as we saw from the Q1 data, Korea is one of the few markets that we see uptick in investment activities in Q1. And in fact, over the last few months, you can see the economy is all driven by the future bubbles, right? So it's more like it's still going on. And China is state enterprises, the state-owned enterprises is actually driving economies, and they are now going back to market. And we are seeing residential sales actually pick up. You know, some of the launches have done well relatively.
Now we had a couple questions around residential assets as well. I'm going to combine two of them. What do you think is driving the risk in declining valuations for residential assets? For example, do you think investors feel the sector was overvalued so far? Or do you feel residential real estate will be more resilient compared to assets like retail and office, with people staying home, for example?
Terrence, you want to start?
Okay. I guess I am not entirely in agreement that residential will be the first most hard hit. But I guess that you know there's an article in the papers today about Hong Kong. You know, we're seeing a lot of apartments being valued at Hong Kong $10 million is substantially discounted below valuation, and some of the reasons may be to meet some of the new regulation that Hong Kong government has imposed, and that may or may not be a real value. But I think for residential, it is an emotional asset. It's the only asset class that has emotions in it, meaning that if I live in it, it will be the last thing I want to sell, right? So unless, but we are not seeing, with this COVID, we are not seeing the recession hitting the market. It will come, but I think it's too early. We probably have to start seeing economic crisis setting in. I know we are seeing some companies in trouble, jobs are lost, retrenchment are happening, but I think it's still too early to talk about that. And so I guess that we will see, I think across all sector class, we will see revaluation. Prices will definitely be revalued. It's the risk premium that we put into each asset classes that will start to differentiate a lot more. So residential will be hit, but will not be the worst hit. Yeah, eventually. Yeah.
David, I think you were going to say something there.
Yeah, no, it's interesting. I mean, when you try to compare to other crises and you try to take data points and benchmarking, what's probably the most different, at least to me, is the fact that during GFC, subprime mortgage crisis, etc., but it didn't affect people of all classes, through the vertical and horizontal chain, right? What we're seeing is a reduced impact in everywhere. It's not just the financial sector, it's not just the subprime sector. So as Karen mentioned, I think it will be a slower burn, but as people lose jobs and their income is decreased markedly, how are they going to make the mortgage payments? And sure, the governments can introduce stimulus and benefit packages, but that only goes so far. So is there maybe not as sharp of a peak in terms of a mortgage crisis, but will there be a slower burn as people, try putting off cut expenses otherwise, but eventually have to forego some of their mortgage payments and give up their secondary homes, or even sell their primary homes and really start to rent? I think there could be a case made for that versus a sharp reduction in prices at least currently.
Okay, in our last few minutes, Sharon, did you want to chime in a little bit on this too?
No, I think they've said everything I would have maybe said as well. I think the only thing I would add, I think, is it's not homogenous, right? It's across different markets, and it really looks at whether a lot of the residential activity in a particular market, especially in the cities, is that foreign investment, is that a second home or investment property, as opposed to owner occupancy. So.
Thank you. That looks like all the time we're going to have for Q&A. There was a lot of questions that came in, but thank you all for participating. We're going to come up on the last few minutes of our webinar, but I'd like to thank David, Terrence, and Sharon for taking the time to answer some interesting questions and sharing some of your expertise with us. I'd also like to thank everyone who dialed in today for all your participation and staying with us throughout the session. As I mentioned at the start of the webinar, we will have a very short survey coming up. My colleagues will be sharing a link. I think they actually might have already done that, where 5 respondents will walk away with complimentary copies of the 2020 Preqin Global Real Estate Report. So please take some time to give us your thoughts. And on behalf of all of us from APREA and Preqin, stay safe, and please feel free to reach out with any questions or comments you might have after the webinar. We wish you and your teams around the world all the very best in the coming months. Thank you, and have a great rest of your day.